Hey guys, so in the first video I forgot to change my background. I actually decided for this topic I'm going to give you a few clues because this one's going to be a little bit hard to guess. So I'll use a different picture for each of the next videos that I'm in. See if you can guess where I am, but probably not. It's pretty tricky. Okay, so here we have the market for loanable funds, which you just watched a couple of videos about, right? We watched a video about saving and borrowing and how we come together to save and borrow in the market for loanable funds, and also how banks help to facilitate those transactions. So supply in loanable funds market is representing savers, and demand represents borrowers, and the market price in the loanable funds market is the interest rate. So let's do this little example here. What do we think would happen to interest rates if more people went to college in the short run? So more people are going to college. You probably know that going to college is costly and requires many people to take out loans in order to finance that investment in your education. So if more people are going to college, we would expect to see more people taking out loans. That would be an increase in demand for loanable funds. And that should lead to an increase in interest rates, at least in the market for student loans, right? But perhaps in different markets, right? Because as more of our savings is going towards funding student loans, then there's less savings available as a society, right, to invest in other types of projects. So here we would expect an increase in interest rate, specifically in the student loan market, but perhaps in other markets as well. Okay, so increase in interest rate as demand for loanable funds increases. All right, so now what about banks? What role do banks play? Well, we watched a video about this. You've learned now that we have a fractional reserve banking system where banks hold a fraction of deposits in reserve, loaning out the remainder of deposits. So banks really here function to match borrowers and savers to help those borrowers and savers find each other, right? To vet people who want to borrow and to reduce risk for people who are saving. So they vet the borrowers, right? They determine what loans are most likely to be repaid, and then they also pool risk for savers. So rather than loaning all of my money to someone else, I'm going to be loaning my money to lots of different people. The bank takes on the risk of default. Like, I don't have to worry when I put my money in the savings account that I'm not going to be able to get it back, because the bank has taken on the risk of default, and that's priced into the interest rate that they're paying me on the amount of money that I have in my savings account, right? So they pool risk for people who are saving. Okay, so this is really important because it helps us, right, to facilitate saving. It takes the risk out of saving, and that helps us to smooth our consumption over time, like we saw in the first video. Okay, now our financial system and our monetary system are kind of always evolving, and regulation of that system is evolving as well. So I want to talk a little bit here about the system that we have for regulating banks and managing our monetary policy. And that's the Federal Reserve System. And we've had the Federal Reserve System around about in the state that we have now, although it has changed a lot since about 1914. And this is the central bank for the US. Now you'll hear about other countries have different central banks, obviously. So anytime we're talking about a central bank, we're talking about the way that the government manages the monetary policy for the country, the money supply, and the way that the government regulates the financial industry, the banks. Okay, so that's what a central bank does. A central bank determines the money supply, the value of money, and how the banking system operates in that country. So we're going to talk a little bit more specifically about what's happening in the US, but all of the kind of broad tools that we talk about in terms of monetary policy obviously can be used in other countries as well. So we have a system in the US where we have 12 regional banks and then one central bank that oversees, the DC Federal Reserve kind of oversees the entire system of central banks. And you'll often hear people talk about the chair of the Federal Reserve as being one of the most powerful people in the world because that person oversees the monetary policy of the US, really helping to steer the US economy, which is one of the biggest economies in the world, right? So the chairman of the Federal Reserve right now is a guy named Jerome Powell. And his job is really to head the organization and also to act as the public speaker for the Federal Reserve, right? So he'll do all the press conferences about what he expects their approach to be to monetary policy, and then also to head the Open Market Operations Committee. The Open Market Operations Committee has 12 members, and they meet 8 times a year. To set US monetary policy. And I've mentioned this, but I just want to make clear that you understand monetary policy is control of the money supply. We're going to talk about this a lot later in a future video. It's control of the US money supply, which helps to steer our economy, all right? So we'll talk about what is the money supply, how does the Fed control the money supply, and how does that affect economic growth? Those are all kind of future topics coming up. But this is the big news that you'll hear, oh, the chairman of the Federal Reserve said that interest rates will remain the same, or they've lowered interest rates, right? The Fed has lowered interest rates now for a couple different months in a row. So this is the big news. We will talk more about how to interpret that news, but this is the person you're hearing about here. So the job of the central bank is sort of threefold. Okay, we've got that they set this monetary policy, right? They control money supply. Okay. They regulate the banking, banks and the financial institutions. Regulate and they monitor them, right? So they set rules, and then they also try to determine whether they're complying with the rules. So they regulate and monitor financial institutions. And they're the lender of last resort to the banks. They lend money to banks really regularly, but also potentially like in an emergency situation. Okay. Okay, so those are kind of the three important functions that the central bank serves. We're going to, again, talk about monetary policy a little bit more in a couple videos, but first we have to tackle this fractional reserve banking system. So we'll do that in the next video.